Hello wizards, and welcome to the Academy, where you will learn about how to read liquidity flows in the global economy and macroeconomics. Today, we're going to introduce you to the Net Liquidity Model. Let's get straight into the dashboard. Here we have the Net U.S. liquidity chart. This model was originally put together by Darius Dale, a world-renowned analyst, so shout out to him. Net liquidity refers to the amount of liquidity readily available to freely circulate within the U.S. economy, resulting from the Fed's balance sheet expansion through quantitative easing. As you can see, the deep purple line at the top indicates the total amount of assets present in the Federal Reserve's balance sheet at any time, which were bought with QE. While the TGA, this area beneath it also in purple, and the reverse repo market, here below in yellow, they act as deductors in the equation simply because the liquidity that is stored inside them is temporarily removed from the markets. Down here, we have the formula, which is net liquidity equals total balance sheet minus TGA plus repo. Therefore, net liquidity results in this green area here, which is useful to measure the potential buying power for stocks residue in the US. As you can see from the KPI in here, in the last 2 years, the correlation between the S&P price and net US liquidity has been very significant. This has been true since the COVID crash, when the Fed produced an astounding $4 trillion in liquidity and injected it into banks in the form of bank reserves that financed the purchase of treasuries from the TGA, which in turn injected the money into the economy. The way we read this chart, as we mentioned, is by looking at the green area and thinking of it as potential buying power for potential asset purchases. The money in the repo, the yellow area, was considered to be excess liquidity and was drawn back from circulation by paying a hefty award rate for lending money to the Fed in a reverse repo deal. If you missed it, be sure to check out the repo market dive that we did at the beginning of this series to get a better understanding of its dynamics. Anyways, there's money from various financial institutions inside the repo, but most importantly, money markets, and we can think of it as mercenary private capital looking for safe returns. As these institutions pull money out of the repo market, they either put it into the treasury, by purchasing T-bills for instance, or they inflate net liquidity. In the same way, the money inside the TGA is withheld by the US Treasury, and it grows net liquidity once it's spent into the economy. It's worth mentioning that net liquidity is a metric that is also closely related to reserve balances. This is because, as we said, most of the liquidity produced with QE by the Fed was accredited to the banking sector as reserve balances. Still, bank reserves and checking account balances are not the same exact thing, even though they mirror each other in a lot of ways. The most important difference at the end of the day is that net liquidity is a much more responsive metric in the short term, given that the repo and the TGA data used to calculate it comes in daily. In fact, you can check the values on a daily basis in the data frame provided at the bottom of the page. Reserve balances, on the other hand, react more slowly due to weekly data updates. We can really consider them as being two faces of the same coin, but net liquidity is a better gauge for short-term liquidity dynamics, while reserve balances are better suited to be looked at as a long-term indicator. Don't miss out on the next videos where we will be exploring both net liquidity and reserve balances with more charts and more models. Thank you for watching, Wizard, and as always, if you enjoyed the content, don't forget to subscribe and turn on the bell icon to help us grow.